My name is John Mutua. I work as a programs coordinator at the Institute of Economic Affairs. So that's the title. You can see it right there. The IEA is actually a think tank that promotes debate and dialogue on public policy issues. And so this morning, we will have two speakers, Kwame Owino, our CEO, and Maureen Baraza, program officer in the Popular Economics program. So the Institute of Economic Affairs has 6 thematic areas. And so in today's conversation, the discussion will be led by the two who work in that program on popular economics and popular economics. Now, we know that the debate on the budget. So basically, we are going to revisit this debate on the budget, and of course, the finance bill and now an act basically dominated much of the debate. So this morning we are revisiting the issue of finance deficit. Now, just for information's sake, as much as yes, the finance bill dominated most of the discussion, we know that, and I think as the two of them will be making the presentation, what the finance bill contains, or the finance act currently, is are taxation proposals. So basically, the revenue or the funds that will be generated from the domestically, what is often referred to as domestic resource mobilization. And the funds that are projected to be generated for this financial year 2023-2024 were about 2.8 trillion, both from taxes and non-tax revenue sources, will only finance about 65% of the budget. So basically, there is a difference that will have to be financed from borrowing. And so those are the details and the discussion that we'll be having this morning. So Kwame, Owino, and Maureen will shed some more light on that, particularly from the context of this evolving macroeconomic environment, in particular with the exchange rate. Of course, we know that our shilling has been depreciating, particularly against the US dollar. So what are the implications of this in terms of financing our deficit? So without further ado, I would like to welcome our presenters. So Maureen will go first. Maureen Baraza will go first. And obviously she will take us through the outline of the presentation, the part that she will cover, and then of course Kwame will come in thereafter. And then after that, we will open it up for Q&A. So we'll follow the same drill. I think this is quite common now. So in case you have any queries or comments, please feel free to jot those in the chat box as we go along. But we'll have a specific session for further discussion after the two have made their presentation. So without further ado, Maureen, please welcome and take us through the first part of the presentation. Thank you.
Thank you, John. Good morning, everyone. I'll be taking you through the first session of our webinar today on how will the Kenyan government finance deficit in the financial year 2023 to 2024. So first we'll look at our outline, and the first thing that we'll be looking at is the budget outcome table for the financial year 2022 and 2023-24. That's the projections. Then the revenue estimates as a share of expenditure. Then we have the deficit as a share of expenditure, and next it will be the breakdown of revenue projections. Then we look at deficit financing, both externally and locally, that's the domestic deficit financing. Next, we'll be looking at the revenue performance for the year 2022, 2023. And finally, it will be the currency depreciation. We'll just go straight to the presentation. And the first thing is the budget outline table for the financial year 2022-23 and 2023-24. I will be comparing the two in terms of revenue and expenditure and how we'll get our deficits. For the financial year 2022-23, we'll be working with the supplementary budget, and for 2023-24, we'll be working with the budget. In terms of revenue, we have the total revenue extracted from the ordinary revenue, and we can see that there's an increase in total revenue from 2 trillion to 2.5 trillion to 2.894 trillion, and this is contributed by ordinary revenue of 2.571 trillion for the financial year 2023-24, and we have additional appropriation in aid of 323 billion for the financial year 2023-24. Also, you can see that there's an increase in grants from 31 billion in the financial year 2022-23 to 42 billion in the financial year 2023-24. And the total revenue and grants, there's an upward increase from 2.5 trillion to 2.9 trillion in the current financial year. So we'll decompose this in later slides to see the different revenue streams that the government revenue projections are looking to collect more revenue. And moving on, we'll be looking at expenditure in two sections. We have the total discretionary expenditure and then non-discretionary expenditure. So for the total discretionary expenditure, we'll be looking at expenditure budgets allocated towards the national executive, the parliament, the judiciary, and the county governments. And we can see that there's an upward increase in the budget allocation towards the national executive, the judiciary, and there's a bit of there's a reduction in allocation towards the parliament and the county governments, and I'll explain in a little while. So for the national executive, it takes a huge bulk of the allocation towards the total discretionary expenditure. And for the parliament, there was a reduction from 51 billion in the financial year 2023-24 to 40 billion in the financial year 2023-24. And this was because there was a huge amount allocated towards the parliamentary building that ended the previous year, and that's the reduction. And for the county governments, this is more of a reduction since the 400 billion. There was a payment that was carried forward from the financial year 2021-22, 2022-23, because the actual allocation for the county governments, the budget for the county governments was 170 billion, and the 30 billion was carried forward. So the 385 billion in the current financial year is more of an increment by around $15 billion. 15 billion Kenyan shillings. And moving forward, we'll be looking at the non-discretionary expenditure. And the non-discretionary expenditure is more of a fast charge, and it reduces the budget flexibility. And looking at the non-discretionary expenditure, we'll be looking at the consolidated fund services, and we can see that there's an increase in the consolidated fund services from 1.5 trillion to 1.836 trillion in the current financial year. And we can see the consolidated fund services contains of the interest, the redemption, pension, and others. And from this, we can see that huge amounts have been allocated towards interest and redemption compared to interest. For interest, there's an upward increment from 676 billion to 775 billion. And for redemption, we have an increment from 685 billion to 850 billion. And this is clear that the consolidated fund services has been dominated by debt, because most of the allocation is going towards financing debt. That's in terms of the principal, that's the redemption, and the interest, both locally and externally. And the general expansion of the consolidated fund services from 1.5 trillion to 1.8 trillion, it signifies that there's a rise in public debt accumulation over time, because the rise signifies that the public debt has increased. Moving forward, we'll be looking at the revenue estimates as a share of expenditure. And looking at this, we have the total revenue, the ordinary revenue, the appropriation in aid, we have the grants, and the total revenue and grants. If you can remember from the budget outline table, we had a breakdown of revenue, and the total revenue has increased from the total revenue estimates is projected to increase from 62% to 65%. That's a 3% increment as a share of the total expenditure. Then the ordinary revenue is projected to increase from 54% to 58%. That's a 4% projected increment as a share of the total expenditure. And the appropriation in aid will reduce from 8% to 7%, a 1% decrease. Then we have the grants that are expected to maintain at around the same level. Then we have the total revenue and grants. That's the addition of revenue and grants is projected to increase by 3% from 63% to 66% as a share of the total expenditure. So from these three sources of the total revenue and grants, that's the ordinary revenue, the appropriation in aid, and the grants, we can see that most of the revenue estimates as a share of expenditure is projected to come from the ordinary revenue. And we'll give a breakdown of the ordinary revenue in some slides to come. Deficit as a percentage of expenditure. And if we can go back to the slides before, I'll just explain. Budget deficit is the difference between the budget and the revenue, the budget expenditure and the revenue. Because if you budget for something and the revenue that you've collected is not enough, the difference between the two is what we call the budget deficit. And that's what we're looking at, how we are going to finance the deficit, the difference between the two. For instance, if you have some savings somewhere, if you have maybe savings of 1,000 bob, and you have, say, an emergency of 2,000 bob. So the deficit that you'll have is 1,000 bob. If you decide to borrow someone the extra money, the 1,000 bob to get your 2,000 bob. So in this case, that's the deficit. What the government has budgeted for and the revenue collected, the difference that you get is what is the deficit. And so the deficit as a share of the expenditure is projected to reduce from 37% to 34%. And narrowing the budget deficit not only does it involve revenue collection, there's also a need for a reduction in government expenditure and wastages of the government resources to narrow the gap for the budget deficit as much as it has reduced. Next, we'll be looking at a breakdown of revenue projections for the financial year 2023 and 24 in billions. This is a breakdown of the ordinary revenue that's mentioned in the budget outline table, and it's in form of the import duty, we have the excess duty, we have the income tax, we have the VAT, we have the investment revenue, and others. So from this chart, we can see there's an increment in almost all streams of revenue. There's an increase in all streams of revenue in terms of projection. For the import duty, there's an increment, and the one that takes the largest share in terms of revenue projection is the income tax, and we'll see the percentage increment in the next slide. So for the import duty, there's a projected increase from 145.876 billion to 173.27 billion shillings. And for excess duty, we have an increment from 297.173 billion, that's in the previous financial year, to the current financial year 23-24 to 352.73 billion. Then for the income tax, we have an projected increment from 1.004 trillion, that's in the financial year 2022-23, to $1.198 trillion in the current financial year. Then for the value-added tax, there's a projected increment from $587 billion to $703.302 billion. Then for the investment revenue, it's more or less a reduction from 35.496 billion to 33.071 billion dollars. Then for the others, it's also a projected decrease from 121.436 billion Kenyan shillings to 110.252 billion shillings. Moving on, we look at revenue stream estimates as a share of the total ordinary revenue. The charts before were in terms of the nominal numbers, and these are the percentages. For import duty, the revenue estimates are projected to increase by 6.74%. For excess duty by 13.72%. Then for income tax, which carries the largest share, is projected to increase by 46.61%. Then you have the value-added tax, which is projected to increase by 27.32%. Then we have the investment revenue that's projected to increase by 1.29%. And we have the other forms of tax for the ordinary revenue. It's projected to increase by 4.29%. Moving forward, we'll be looking at the net deficit financing. And what do you mean by the net financing? The net financing is the difference that you get when you pay minus what you pay minus the interest rate. And for the net deficit financing in billion shillings for the financial year 2023-24, for government securities, that's the treasury bonds, treasury bills, and other forms of government securities, say the infrastructure bonds and the water bonds, that's 598.323 billions Kenyan shillings billion. That's what's expected for the net deficit financing for the domestic loans. And then for other domestic financing, we seem to have a reduction of 11.881 billion Kenyan shillings. Yeah, thank you.
All right. Thanks, Maureen. So, as you all know, what we're trying to, the reason we're discussing this, of course, these are all budget numbers, and we discussed them about a month ago. But the reason we're discussing this is just to find out what's the net financial position for government based on this year's budget numbers. I think 1 week ago, the Kenya Revenue Authority released the final numbers for revenue collections for the year. Of course, with the 95% performance, in the sense that 95% achievement against the targets. What you're trying to explain is, based on the budget outcome, which is on the first slide of this presentation, we ask ourselves, how is government filling the deficit, which is basically the difference between how much money is spent in total and how much revenues are collected. And primarily, as Maureen has mentioned, throughout this presentation, is that it's filled in two ways. One, either from grants, which is about 42 billion, and then the rest will be filled from, on a net basis, from domestic borrowing and from external borrowing. So we come here to this slide, and all it's trying to explain to us is, in terms of the financing, deficit financing, what amount of money is being borrowed externally and what amount of money is being borrowed internally. The external financing has specific implications because, as you know, when the budget was read, the Kenya shilling was exchanging at about 139 shillings for $1. We looked at the central bank's numbers today, and on Monday it was at 142. That 3 shillings or so difference has significant implications for the debt servicing costs that the government will face. So that's the first thing. The second one is, we know that the finance bill, that government has, that was passed in Parliament, which in my view should be Parliament's and not necessarily the executive's responsibility anymore, is stuck, if we may say, or at least still the subject of contention in a court case that will be resolved sooner than later. So what you're trying to show is what might that mean, because that matter will be resolved one way or the other. What might it mean for governments? What might that mean for overall government position? Now, in the previous slide that we've looked at in terms of the debt servicing cost, we've seen the split. But here on table one of the first things we'd like to ask ourselves is, what's the change in the interest payments or rather, what's the change in debt servicing costs? External debt servicing costs based on that change in about 3 shillings and 20 cents per dollar between July 1st, when the budget season started, and obviously to today. So if you look at it, the interest payments on external debt this year that was expected to be 146 billion Kenya shillings, and the principal redemption was 475. So as you can see, the interest is just about basically slightly less than 1/4 of the total amount that's being slightly more than 1/4 of the total amount that's being paid out. So the total that's supposed to be paid out based on the nominal value, on Kenya shillings, was about, as you see here, about 600 billion rather, Kenya shillings billion. That same amount in exchange rates today, or rather in US dollars, based on the exchange rate that obtained on the 1st of July, would have been, the interest payment was $1 billion. The principal payment was about 3.403, of which, of course, part of it is the Euro bond and the Exim Bank payments that are due in the course of this financial year. So that's $3 billion for principal and $1 billion for interest, as these numbers suggest. If you take a straight line simulation based on the changes in the interest rate, which is about 3 shillings and a bit, between 1st of June, between the date on which the budget was read and today, the increment on the interest payment alone in Kenya shillings is 2 billion, based on that 3 shillings, and the increment on the principal sum is 8 billion, meaning that if government of Kenya would pay back, is supposed to pay back the loans that are due for this year, both in terms of interest and principal, for external servicing of loans, the external component loans, between June, when the budget was read, and today, July 24th, the incremental difference on account of the change in the interest rates would require an additional 10 billion shillings, which is equivalent to an additional 1 day of revenue collection. So what we are trying to illustrate here is basically on the basis of the change in the Kenya shillings, or rather the depreciation in the Kenya shillings, the debt obligation that the government of Kenya has to pay in nominal Kenya shilling value has changed. And so basically what it means is we'll need an additional 10 billion shillings to service that same amount. I am conscious as well that obviously the government of Kenya will be receiving some money. The IMF payment, of course, is coming in. It's supposed to come in. So there'll be a form of offset one way or the other, because of course money is fungible. But on the whole, in nominal terms, because this will have to be paid for on the basis of Kenya shillings, and there's possibility of switching, it represents an additional 10 billion shillings worth. It's probably much, much less, because obviously it's a little less, because obviously if the money from IMF comes in dollars, it is possible to use the same amount without necessarily transacting them. But because taxes are paid, those taxes redeem the dollars that would then be used to pay back. It represents, if you must call it, a deterioration of 10 billion shillings in terms of difference. Now, in the next slide, or rather, so this is basically the deficit financing, and it tells you what the deficit financing in total. The total was basically 600 billion in terms of total foreign financing that would be required. Of course, as you can see, part of it, of course, in total financing, not foreign financing, in total financing that would be required. So part of that reflects all these payments in terms of project loans, rapid credit facility, which is the one that's coming in from the IMF, which was approved last week or the week before that, about 10 days ago, on the 14th of this month. Then there's obviously commercial financing. So all this basically is a decomposition of what the financing would be what was required. But the main point we are making is that change, remember, the deficit financing is likely driven by domestic debt on one side and external debt. On the external debt side, the domestic debt, the depreciation of the Kenya shilling has had that grave effect. In the next slide, so let's talk about, I think there's overwhelming reliance, or rather, let me say, there's most of this year's debt or rather the deficit will be, the deficit coverage will mostly come from the performance, or rather domestic revenues, on account of the fact that there'll be less foreign borrowing this year relative to the previous years, and the share of total borrowing that comes from external sources would be less as well. Meaning the government is relying on domestic revenue performance. And that also tells us why the question of the Finance Act 2023 is a critical one. Be that as it may, obviously it's in court, but I think its resolution is essential for how this balance, this year's budgets will be balanced. But the way to actually cut us and tell us what's the reality around this, let's look at the KRA's report card. As we're preparing for this last week, the KRA released a statement, not all the data, but a statement telling us what the position is in terms of the collection of cash. Now, that's important for us because if we see the performance record, we can then extrapolate or reason about what are the prospects for covering this year's budget deficit, which Maureen has spoken about and which I've spoken about. So the first one shock that we spoke about was the deficit, rather the depreciation of the Kenyan shilling. But let's look at the KRA's report card dispassionately. Sorry. And what it tells us here is that nominal revenue increased. Nominal revenue collection increased from 1.58 trillion, tracking a 5-year trend line, to 2.16 trillion for the 2022-2023. So basically, if you look at it from 2018-19 financial year, total revenue collection was 1.58 trillion. And last year, based on the reported figures, it was 2.16 trillion. Remember, this is all total revenue collection. It's not the exchequer collections. The KRA collects other revenues that are not necessarily part of the exchequer. It collects revenues for other institutions in the public sector, say, for instance, the airport fees, and a couple of others that are not necessarily part of the straight line. I mean, going to the budget directly. It collects other revenues. So basically, it's reporting on its total revenue collection. However, the exchequer revenue, which is the center of our interest today, was 1.9 trillion in 2021, and it improved to 2 trillion and 30 billion for 2022-23. Sorry, that's a typo. For 22-23, this represents a 6.9% increment. The KRA itself admits that this is good performance relative to obviously what the performance of the economy is, on account of the fact that in 2021 and 22, the economy was recovering off a low base from COVID. And this year, of course, towards the end of the year, things got a little tighter. And so the revenue performance is 6.9% below inflation levels, suggesting that basically it barely met what the inflation levels were. So in a way, suggesting that in real terms, revenue collection was flat. Or slightly less than what it should have been if you accounted for inflation. In the next slide, we're speaking about the fact, let's go back. So the composition of that revenue collection by what tax heads generated what. Again, the KRA reports on that statement that the domestic taxes grew from 8.5% of last year's base, the last financial year's base, from to 1.481 trillion. And this was equivalent to 95% of what the projections had been. So basically, based on the projections, they're just 5% below what could have been. And they explain that on account of the fact that, yes, it was a little bit more difficult towards the end. But they also say that special exemptions for food items moderated the growth because government came in with the idea to moderate taxes on sugar, grains, and many other things for which, of course, tax collection would have led to much higher revenue collections. And the KRA seems to agree that obviously that was a condition made, that was a response conditioned by the fact that, yes, food prices went up and government wished to cushion citizens from it. Custom taxes on the other side grew by 3.5% to 754 billion, again below inflation rate. So in total, basically explaining the biggest domestic taxes growth was 8.5%, custom taxes growth was 3.5%. So that's the smallest. I mean, that's the gap. That's the gap. So, quote unquote, moderately performing custom taxes growth, and obviously domestic taxes growth at 8.5%. The difference in custom taxes growth is explained by the special exemptions for food items based on government policy. we go specifically to other tax heads. Again, this is essential. I know it's a repetition, but it's essential because each of these tax heads and specific tax proposals were included in the Finance Act, which is the subject of contention today. And we are arguing that its accomplishments, or rather, its resolution is essential for how the budget deficit will be resolved or covered. So excise tax on betting, the KRA mentions that it actually was 116% above what the projection was. The target was 5.715 billion, and instead a receipt of 6.54 billion. So basically 16% ahead of target. Domestic VAT grew by 11.3% growth, and it came down to 272. So remember, the VAT as a whole, and domestic VAT would be domestic VAT collected from domestic consumption. External VAT would be from basically imports for which VAT was charged. So domestic VAT grew at 11.3% to 272 billion over that year. Corporation tax, on the other hand, grew by 9% to 263. So that's income tax from corporations. I think this is one of the things that we sometimes find a little confusing for KRA, because in reporting, sometimes they say income tax from corporations, other times they say corporation tax. I think standardization of this nomenclature in our view would be useful for the purposes of this categorization. So here it's reported as corporation tax. I think that is income tax generated from corporations, 9% growth to 263 billion. And then look at pay as you earn, which grew at 7.2%, just barely keeping in touch with inflation at 494 billion, 0.978. In that note, there's an interesting bit. This 7.2% growth was actually conditioned by most growth from private sector, and private sector contribution to pay as you earn grew by 10%, while it grew by, as reported by the same report, it grew at only 1.9% for all public sector revenues. So in other words, pay as you earn collection by government between those 2 years grew 21-22 and 22-23 grew by 1.9%, while for the private sector it grew by 10%, suggesting that there's a recovery of payrolls, especially the private sector, and not necessarily as much in the public sector. And domestic excise tax collections grew by 2.8% to 68 billion. Really, really low. So in all, you can see that the labor taxes grew at a higher rate, which is basically income taxes and labor taxes grew at a higher rate. And then, of course, a consumption tax that grew the fastest was VAT, but also because VAT adjustments had been made. So part of it was a rise in tax rates. And obviously, the KRA will report that in closing loopholes, and part of that, obviously, the explanation for domestic VAT growth comes in the next slide, where the e-teams mechanism was strengthened. A new mechanism for reporting real-time transactions also led to less diversion of taxes. My words, but the report that basically covered as many loopholes as they could. In our next slide, we're explaining what were the drivers of revenue growth. Again, this is using the language or paraphrasing the language of the KRA in that note. Impressive was an expansion of the tax base. 940,000 additional active taxpayers were recruited, and they paid an additional 14 billion shillings in taxes. So if you divide one number by the other, it means the additional taxpayers that were brought in paid an additional 15,000 shillings over the whole year. Impressive regardless. But my view is that it's telling us that, yes, I think perhaps KRA is reaching the limits of additional recruitment being a big bust in taxation. Because of, as you can see, 14 billion shillings is not small change. But if you look at this additional 14 billion shillings, still it accounts for just about 1% or less of our total taxation for that year. Essential still. And then the e-teams was onboarded, and it's onboarded 95,732 registered taxpayers. So basically that's on e-teams of the VAT side. And then the Kenya Revenue Authority also strengthened debt collection for non-compliant taxpayers and raised an additional 99 billion. This is essential, but the reason we mention it here is it's essential. But basically, it's a bounce back from a low revenue base. So obviously, it's not sustainable for the next year, because if you're covering, as you cover, obviously there's not another 99 billion that's available out here. So next year's growth rates will be conditioned on a one-time badge. And in dispute resolution, resolved 7,458 cases were concluded, which raised an additional 71 billion in disputed revenue. So as you can see, the revenue growth really did occur, but some of it was resolving administrative issues that had obtained for a while. So as you resolve these cases, obviously those revenues get paid. And if you have 71 billion, unlikely, unless there's any more cases out there, it's unlikely that you have another 71 billion shillings coming from another 74,508, I mean 7,458. So yes, closing gaps is essential, but we need not overplay what they mean for future revenue collections. I think what it means is it will stabilize revenue collection at a level, but I think it has modest implications for how revenues will grow unless the economic growth takes place itself, and obviously farm performance and employment performance get better. In our next slide, we're trying to explain so the currency depreciation against the US dollar between January to June. But here we are, the June numbers, which I've discussed, was 139, and we know this has significant risks or implications for debt servicing costs, especially because they're big two-ticket items. One is the Exim Bank SGR payment that's due next year, and sometime this year as well. In the next half of the financial year, there's the Eurobond payment. If you look at this against the government's reserves, this is an important point. You all know that early last week, Fitch, which is one of those global rating agencies, stated in a note that was issued that they'd also downgraded Kenya's performance based on two things. One, they were seeing difficulties with the full implementation of the Finance Act 2023 on account of its being in court, and I think that might drag for a while. The second point was they mentioned part of the social costs and the social unrest that had taken place. I mean, we need not go into that. We understand what the politics of that is, but it's a difficulty regardless, suggesting the a little bit. It will take a little longer for this to settle. It might take a little longer for this to settle. The depreciation of the Kenya shilling and some of its implications for the ability to pay the two big ticket items that are designated in the dollars, and they seem to think, which worried us at the Institute of Economic Affairs, that the depreciation of the dollar is not over yet. I think suggesting that, yes, if they look at that, looking at Kenya's reserves and some of the things that need to be paid. Remember, in addition to these two big ticket items, which is the dollar, I mean, the two loans, I think there's a big transaction that the government of Kenya entered to. It's called, which we've called the government-to-government transaction, but really it wasn't. It's just an agreement for an escrow account to buy and purchase oil. Many people think that when that agreement terminates, or when it comes to the payment terms after 9 months, the big demand for dollars in Kenya's market is going to create a further depreciation of the Kenyan shilling. So in watching all those and putting all those together, their view is that Kenya's stability in debt payment has been relegated. You know that in May of this year, in April of this year as well, there's a different note, far more detailed than this, which also, of course, showed that a different debt rating house had the view that Kenya's debt position and financial position overall had become worse. Not good news overall, but I think depending on who you speak to, many people think that this was foreseen, and therefore these changes have been already integrated into prices at markets. I hope they're right. I suspect not fully so, but I think we need to watch as we go forward. So as we conclude, what we're trying to, what we're showing here is two things. One, I think on the whole, look at it from April to today, we haven't had any more that salaries that delayed and everything else. So yes, there's an extent to which there's been a balance in the public finances. We have a new budget. The finance bill might be a different spin altogether, but all we try to emphasize here is that the resolution of the Finance Act, sorry, I call it bill, it's an act because it was passed by Parliament and signed into law by the President, means that resolution in court, telling you how institutions are important. So it looks like the performance of Kenya's judiciary and the findings on this law will have significant implications for how Kenya resolves the deficit that we spoke about. That's one thing. And the second thing is obviously currency depreciation and management is something we need to look at, because it has implications not just for the payment of the two big ticket items, as I call them, the SGR payment that's due, and obviously the Eurobond that's coming forth as well, but also on the fact that there's a huge transaction that government entered into, an escrow account. Obviously, Kenya shillings are used to buff it up, but when the payment time comes, government is going to have to demand, or rather, there's going to be a huge demand for dollars, and that might have implications for the depreciation of the Kenya shilling further. If that happens, we all know what every significant shilling change on the Kenya as it is right now, based on this year's obligations, every 1 shilling change creates additional 3 billion worth of obligations. And all this happened in the space of a month. So let's hope that the Kenya shilling settles sooner than later. So thanks. Done.
Yeah, thanks, Kwame and Maureen, for taking us through. Let me see my video. Taking us through basically how the budget deficit will be financed. So we had Maureen painting a picture, basically taking us through those numbers in terms of the revenues that are projected for the financial year 2023-2024, both from basically ordinary revenue and appropriation in aid. So basically all the revenue sources, including grants. And the figure there comes to about 2.9%. 2.9 trillion, sorry. And then compared to expected government expenditure of about 4.4 trillion. So the difference between that revenue and expenditure is what will lead to the deficit. So what Maureen showed or took us through is how this deficit will be financed, both from borrowing internally as well as externally. And the punctuation is that by looking at the current debt servicing cost, Kwame came in and basically showed us how the exchange rate depreciation or the depreciation of the Kenyan shilling against the US dollar. Of course, a majority of our, I think 70% of our debt, external debt, is actually denominated in the US dollar. So obviously, depreciation of our shilling against the dollar has major implication. And you can see from this simulation, straight line or linear simulation, the implication of this depreciation will lead to that additional increment in external debt servicing. So basically, the importance of looking at the changes in the macro environment and the implications they have on the budget. Then secondly, looking at those projections in terms of revenue sources, in nominal terms, what Maureen showed is that all those different revenue sources, whether it's your income tax, excise duty, VAT, all those are actually projected to grow in nominal terms. But it's also important to look at this against performance of the previous years. And what Kwame showed is that, of course, KRA had this impressive performance. But in nominal terms, this actually, the performance against the target was quite impressive. However, when you factor inflation, you can see that in real terms, the collection was actually below. That growth was actually below inflation of about 8.8%. So of course, in all these deficit financing aspects, it's always important to come back again to the to how much resources we expect to generate, but also check it against the performance, and that's what basically Kwame has both Kwame and Maureen have taken us through in this presentation and the implications those two have. So as much as KRA performance is quite impressive, especially against the target, you can see it's already somewhat reaching its limit. And there's actually these are huge implication, and obviously the need to grow the economy in order to generate more revenue is critical. But obviously the ruling on the Finance Act will also be an important element to all this discussion. Okay, so those were my takeouts from this from their two presentations. I mean the two speakers, participants. If you have any question or comment, please feel free to unmute or just raise your hand and I'll be able to I will allow you to basically pose your question. You can do that. You channel it to either Kwame or Maureen. And so far, I don't see. Let me see whether we have any queries in the chat box. So far, we don't. I'd like to invite you participants. Do you have any question or comment for our two speakers? Is that Evans? Yeah, please go ahead.
Yes,
Evans.
yes. Looking at the revenue projections, it would appear that we will comfortably finance our debt. And the other bit that I wanted to ask is the implication on businesses particularly, and also the welfare of the public generally, given the fact that we are also into inflation, and clearly the rate of inflation is higher than the increase in revenue targets. Because the reason the finance bill is in court is because of the implications.
Okay. Thanks, Evan. I hope. Sorry. Okay, go ahead.
Hello?
Go ahead. Yeah, just go ahead.
Yeah. So I just wanted to ask, as much as we would feel safe in financing our deficit, don't you think that we should also be cautious about the general welfare of the public and also businesses?
Okay, so that's well noted. I think the two speakers have noted that. So we'll have a first round and then open it to the final second round. I mean, open the plenary to another round. Yes, Anne, please go ahead. You can unmute yourself and go ahead.
Thank you, John. Very good discussions going on. I don't know whether you can hear me.
Yes, we can. Please go ahead.
Okay, I'd like Kwame to comment on something. I think I recently followed through some discussion he was having about the dollar bonds. I never got to understand something he talked about. Something really bad happening in case it doesn't go the way it's supposed to go, and this is in relation to the fact that he has rightfully mentioned that we have two big ticket items being requiring payment coming up very soon, and then there is of course the discussion of the the CBK floating the dollar bond. So I would really want him to comment on that. Thank you.
Thanks, Anne. Do we have a third question or comment? Okay. Okay, so Kwame, please. I hope you've noted the two. You can go first, and then if Maureen, you have something else to add, please feel free. And then we'll have another round. We'll go for another round. Yeah, thank you.
All right, thanks, John, and thanks for this. So Lillian, I hope that's the name, Lillian. Yes, about the dollar bonds, I think the conversation around the dollar bonds came out during the confirmation hearings for the central bank governor, at that time speaking in parliament. And what he said when he was asked about the depreciation of the Kenya shilling and the risks that attended to that, what he said was that it is very, very clear that many Kenyans, and he mentioned a figure close to, I cannot remember, but it was definitely more than 5 billion. There was something like $7 billion in circulation in Kenya, but people are unwilling to trade them because the reference rate that the central bank was referring to, was using, was not attractive to people. And the interbank market was not working well, which was being fixed. He considered it wasn't working well, but there were initiatives to fix it. So what he said before Parliament, again, I paraphrase, it's important in the conversations that we have, especially these regarding a delicate economic position, to state properly, but I'll paraphrase. What he said was that if people are willing to give, to trade dollars, quote unquote, in the markets or within banks, one of the things government could do was actually to raise a domestic dollar bond. So ask people who have those dollars to give it to government, so government will buy those dollars and of course give them an interest rate on that basis, which is clever. Now, and that might resolve the question about the shortage of dollars. So the shortage of dollars in Kenya is not because there are no dollars in pockets and wallets. The shortage of dollars is that people don't trust, quote unquote, the market as it exists, and the quoted fares, the quoted rates do not reflect the price that many people think is the valid one. And so it was creating a shortage and then creating more pressure for that appreciation. So that was the solution. My response was based on the fact that, look, the dollar is not Kenya's domestic currency, which is true. So basically what it means is that we'd have to be competing the US. Part of the reason the dollar has been appreciated in Kenya, and not just because of Kenya's domestic pressures, but also because globally, when inflation started to rise in the US government started to tighten monetary policy, which means government raises interest rates. Now, because the US government or the Reserve Bank of the US is the issue of the dollars, what happens is many people started to withdraw dollars from other parts of the world to send it to the US because the interest rates were very attractive. And our views would be, my view at that time was that that would be very, very interesting because you'd have to be competing a country such as the US, huge credibility in the central bank, whatever people say, that's a central bank, a central bank. Huge credibility, raising its interest rates at the same time in order to manage its own domestic inflation pressures. And then we'd have to compete those interest rates. So it means we'd have to give a significant premium for somebody with $100, for instance, to suggest, let me give it to the Central Bank of Kenya, as opposed to giving it to the Federal Reserve. So that's my assessment of that's part of the reason why I said it was interesting, but I was cynical about its possibilities of success, especially if the reason Kenyans were not giving money, or rather were not responding by opening markets to trade, and what the central bank was quoting on its website, and when you go to your a specific bureau off the streets, maybe perhaps just 2 streets away from where the central bank offices are, would be in some cases as much as 4 or 5 shillings higher than what was being quoted. So that suggests that we need to fix the market as opposed to trying a short-term trick, which would get in some of those dollars. Those people would actually have to be confident that when they need their dollars finally, they would get them in the best condition. So basically part of the problem with the depreciation of the Kenya shilling are not just the trade and economic conditions, but its trust in the central bank and the mechanisms that exist for the interbank trade. And you don't fix that with a clever trick such as taking the dollars. So that's the response. I say that's the basis for the response that you saw. I hope I didn't sound very cynical as you suggest, but yes, I think there's a problem up there in the economics that suggests that we need to fix something more. So the shortage of dollars was a symptom as well, and not necessarily the cause. So just wiping those dollars for today and then keeping them and using them to pay would actually be a problem, because those dollars would have to be paid for. And when you have to trade, you might have to trade if government's credibility, or rather central bank's credibility, and the interbank market is not allowed to work openly, it would be a problem. I will conclude by saying that the the dollar rates that the central bank had on their website, it's since shrunk, but it's still, there's a big difference between going to a bureau and actually when you look at the reference rate at the central bank, it was telling you that the rate that the central bank was giving, right, had no information value for market participants. And that's a critical question about the credibility of the central bank's numbers. So that you can't resolve necessarily by simply issuing it. So you needed to make some more reforms to make sure that the credibility of the interbank rate is restored, and that people are able to trade more efficiently and more freely, so that they're not keeping dollars in their wallets or in vaults at home, for instance, when they could trade them as well. The second question was from Honor, implications. Now, I think, yes, our purpose for having this webinar today was basically to simply ask ourselves if we take stock about the fact that, yes, our deficits need to be funded, and deficits are only funded in two ways, either by domestic borrowing or by external borrowing, because the government of Kenya does not have reserves. So what that means is, what's the state of play? So what we just wanted to ask people is, if we take stock what's happening right now, and then to create a balanced view about what it means for this year's public financial performance in budget execution. We know that inflation is is higher. And so last year's inflation was higher than the growth in revenue collections, all of them collected. And as you saw, revenue collections from the highest at 10.5% came from payee, and not even the VATs and all the others, which were all at or below inflation, suggesting that obviously they were at lower rates. So the lesson we extract from that is that unless something fundamentally changes in today's economy, some of the targets that have been set today for revenue collections, whether it's from VAT, right? Whether it's from corporation tax and all that, may not be met. Or unless a burst of economic growth resumes very, very quickly. Then that's what so we are calling for more modesty in the way we forecast revenue. It is clear that the government's response, and by government I mean both the executive and parliament, seem to be agreed that a fiscal consolidation that involves reducing expenditures is not something they will contemplate for now, and therefore they are betting on aggressive revenue growth to be able to get it. If revenue projections, which were at about 2.2 trillion, right, came down to about 2.01, barely. The number was initially 2.3, and then it came to 2.2, and then adjusted downwards. We're simply placing these numbers and asking, on the basis of the economic reality, at least given the numbers that we have and can examine today, is it possible that there's too much optimism around what the revenue effect would be? And that makes even the finance bill increasingly stand on shaky ground, on account of the fact that if it doesn't pass, then it is very, very clear that there will be tight moments. Even if it passes, as we all know, on the fuel question, for which the courts already had an injunction, but the public sector, IPRA, and fuel dealers have not been instructed to actually reprice the fuel. So it means that the fuel knock-on effect has already come in, prices are going up. How that affects market performance will be essential, but we see a desperation on the part of the public sector, and specifically the executive branch of government, even notwithstanding a court order, to ensure that the revenues are collected. So there's this grab, or this desperation to collect revenues, suggesting that obviously this budget stands, or rather, it's very delicate, and those are the risks we intended to highlight and create today. So yes, inflation is a standing one. So while we report the KRA's performance as standing, if you adjust for inflation, then we are barely at the same revenue collection levels as were collected in the year 2021-22, when there was a big bounce back, and obviously growth rates were much, much higher. So this position that has been advertised for new revenue collections and the budget is very dependent on the growth momentum being maintained. And that tells you one reason why we ought to be more serious about whether there's matabano on Wednesday or not, because it's clear that getting policemen to wake up and sit in the roads at 5 o'clock might not stop it. So I think we need a broader conversation about what those implications are. So that's one risk of economic performance. The other risk of economic performance is how markets react to the changes in prices that will come from the knock-on effect of tax rates being hiked. That's another risk. We also know that the exchange rate is also one other risk. That notwithstanding, we understand the government position has evened out quite a bit, because there's the possibility that the IMF, not a possibility, it's now a certainty that the IMF loan, which is the Rapid Response Facility, has been approved. That $600 million worth of new currency will be coming in. So this is a question about balancing that. Inflation remains a reality, and it tells us why we think that managing inflation is an important imperative for government today. Yes, it's an important one, because it just doesn't affect market performance every week, but it's also one of the ways in which we could deal with some of the social costs of the imposition of new taxes that seemed to have been understated, but which we at the Institute of Economic Affairs had called for. I think we needed a more cautious way. So the finance bill did not just face the risk of the political risk of not passing in Parliament. I think that was almost forgone early enough. But the social risks that we see were foreseeable. And we think, in my view, they've not been competently managed. Thank you.
Thanks, Kwame. Maureen, would you like to weigh in on any of the two questions or make any additions?
I'd just like to make an addition on Ivan's question on how the implication of deficit on business welfare. I'd like to add the fact on the crowding out effect, whereby the government, like it has been mentioned before, financing the budget deficit requires borrowing either domestically or externally. And there's been more emphasis on borrowing domestically. And if the government decides to borrow domestically, it will crowd out the local investors and businesses that trying to like secure credit from local banks, because the banks consider government as a low risk borrower. So these businesses will suffer from the crowding out effect. Yeah, thank you.
Okay. Yeah, thanks for those responses. So we'll go to the final round of questions, and I already see one in the chat box. So I'll just read it out. Again, if you like to raise a question or make a comment, please feel free to unmute or raise your hand. So Victor Abayo asks, it will be important for, I don't know if it's a question, but I'll read it out. It will be important for the expected increase in revenue collection to recognize the change of behavior by employees and employers in response to increase in tax rates. How practical is the expected increase? Okay. So Kwame and Maureen, you guys cannot. I hope you've noted that. Do we have any other question from our participants? Okay, I have one that again I'll post to just open to both Kwame and Maureen. So I'd like to basically get your comments on there's a statement in the budget. There is something noted in the budget statement that obviously the deficit is actually projected to reduce from 5.7% of GDP in 2022-2023. Of course, this excludes redemptions, to 4.1 in 2023-2024, and eventually to 3.6 by 2026-27. So given the economic realities, what are your thoughts on this in terms of whether this is achievable or not. Okay. We seem not to have any comments or questions in the chat box. So I think there's one from Hussein. Can government peg on expenditure growth with sector performance? That is, amount of county allocation be pegged with on. Okay, Hussein, I think the question is not very clear. Do you mind just clarifying what your question is? Hussein, are you there? Although I guess what you're saying, do you mean on whether the expenditure by counties to be only pegged on source revenue? I'm not sure whether that's from the second. Is that what you're asking, Hussein? Are you there? Okay, I mean, that's what I can somewhat decipher. Hussein, you can unmute and ask your question. Just clarify or expound on your query. Please go ahead, Hussein. Okay.
Hello, do you hear me?
Yes, yes, I can hear you.
What I mean is there is revenue allocation from national government that's allocated to the county government. For example, if that amount will be fixed on the amount of performance from the on-source revenue per county is also targeted. If they cannot generate the amount of on-source required per county, and maybe the other sector indicators of, for example, financial prudence management. For example, what I mean is if it can be backed on that one, so that the amount allocated will be deducted if all source are proportionate with the all source revenue.
Okay.
Is it clear?
I think it's clear. So do you mean that allocation to counties be pegged on performance on source revenue? Is that what you mean?
Yes. The allocation should not be guaranteed, irrespective of the county performance on all source revenue and prudent of financial resources management.
Okay.
Okay, thank you.
Thank you, Hussein. So there have been no other question. So I would like to invite again our two speakers. We'll start with Maureen. Feel free to answer any of those questions, and of course make your final remarks. And then thereafter, Kwame, you can come in as well.
I'd like to answer the question on the projection on budget deficit reducing from 4.1% to 3.6% in the coming financial year 2024-25. Well, I think, okay, in my own opinion, I think this looks like somewhat an ambitious projection, given that we currently are experiencing the high inflation rates, and also given the performance of revenue collections in the past financial years, the revenue performance has been lower than the expenditure. So the government has been spending more than what it has been collecting. So the deficit is expected to probably grow in the coming financial years. And also the question on the practicality of expected increase in revenue collection to given the change of behavior by employees and employers and the increase in tax rates. One thing that I think will happen probably the change in tax rates and maybe the additional taxes from the proposed finance bill might affect the employment rate in the country, and the practicality of the expected increase. Well, it's hard to tell. Yeah, thank you.
Thanks, Maureen. Kwame?
Okay, thanks for the question. So I have a question about from John, from Victor, whether the expected revenue increase is realistic. Well, I think for the last few years, we've had automatic revenue increases. We've had automatic revenue increases for the KRA. And the biggest predictor of good revenue increment is just basically economic growth. So if growth takes place, obviously, that means that economic activity has happened based on last year's foundation, and therefore some revenue will grow. What I question this year is whether the raft of the revenue increase, of tax increases, tax rate increments on VAT, income tax, and all those, their collective effect will lead to a revenue increase, because it's possible some of them will cancel each other out. So, for instance, the Federation of Kenyan Employers, and they tend not to be frivolous, have mentioned that some of the increases put together, will be onerous for big-time employers. And obviously, as you saw, that should worry us, because wage employment by far is the biggest revenue head by a big amount in the country. So if employment goes down or it fails to grow quickly, then obviously we're going to have a problem, because as it showed, even while government is responsible for 1/3 of all employment, formal employment in the country, last year, government, quote unquote, public sector contributions to payee grew by only 1.9%, well below inflation, and only private sector growth on revenue grew by 10%. So obviously that tells you that the dependence on private sector growth on revenue is enormous. And if employment roles are affected, then the possibility that those revenues will grow, or at least as anticipated, is to be questioned, comes to question. And then the second point is price rises, especially the doubling of the VAT rate on fuel, and its possible knock-on effects on other forms of consumption. I think that too would be something to watch for, because some petroleum dealers were suggesting, it's too early to say, but some petroleum dealers were suggesting that petroleum consumption, based on the first weekend after the law was passed, was much less than they anticipated, and it was so quick and sudden that they actually noticed it, which would be worrisome if it carries over to the next throughout the year. So yes, there are no certainties around this revenue. I think for a very long time, the government of Kenya has been the revenues. If you saw the excise taxation, on excise taxation, the government had raised tax rates over time, and you saw last year excise taxation total growth was 2.3%, again below the growth rate and also below inflation, suggesting to us that we are probably reaching the limits of how much can be actually raised. So if you put all those things together, and noting that this year was a much better year than next year would be expected, if revenue performance or revenue targets were at 95%, we might have required, I would suggest that both Parliament and the Executive ought to have agreed on a far more modest expenditure expansion, and therefore revenue expansion than what they have today. On John, yes, I think deficit change from 5.7% of GDP to 4.1% of GDP in 2022-23. I don't see a 4.1% of GDP attained in this year for the reasons that we mentioned at the risks. One, government's borrowing costs are itself going up. Government is not able yet to borrow long term, so most of it is treasury bills. When treasury bills get to 15%, borrowing for a year and beyond gets to 15 and 17%. It has a knock-on effect as well on funds in terms of borrowing and private sector investment. So people are not going to borrow money at 20% to invest. Some people will. Many businesses will not be able to borrow that rate. So the possibility of value addition and economic growth is affected entirely by government's borrowing behavior now and the constraints that has placed on it by virtue of the fact that there's a huge debt servicing cost to be borne. At the same time, we saw the depreciation of the Kenyan shilling. Many of us at the beginning of the year did not think that the Kenyan shilling could get, even in the worst case, to 120. It's well past that. I think we have politicians in the executive especially talking it up. I think it's time for them to just bide their time, be a little more patient, because every time they talk it up, it creates panic and it actually goes the opposite direction from what they say. So in a manner of speaking, they have to stop cussing the shilling because they're making everybody's lives far worse. So yes, if you take those two together, I'm not too sure that because it raises borrowing costs and it makes that difficult. So it's too early to actually think, but on my own, I am a bit doubtful that a debt to GDP ratio, a deficit of 4.1% would be achieved, because if it was a deficit of 4.1%, it would be far modest. I think it will definitely be above 5, and it might even reach 6 if other conditions occur, especially if there's a global recession, which is less likely now, but seems more likely a while back. We hope it doesn't happen. And if the El Nino season doesn't destroy agriculture and, of course, the knock-on effects into other sectors, then we hope that it'll get better. But 4.1 would be extremely ambitious, and if it was achieved, that would be spectacular performance. Hussein asked a question about, can government peg expenditure growth to sector performance? Hussein, this is for counties. This is one of the things that I find very, very interesting, is pegging county allocation to on-source revenue very prudent. I understand that this question is based on the fact, a common narrative sometimes promoted by people in the national government, that counties are inefficient, waste money, and are not collecting money, and quote unquote, for that reason, dependent on nationally collected revenues. Now, let me disabuse us of one thing. According to the Constitution, revenues collected by the national government do not belong, collected by the Kenya Revenue Authority do not belong to the national government. Those revenues are revenues collected at national government level based on the tax bases that the national government has provided, or rather has been accorded according to the Constitution. And they are only the national governments, once the National Assembly on one side and the Senate agree on the partition between, or distribution, which is the allocation of revenue between the national government and the county government, conditional on the requirement that it should be at least 15% of what the last audited accounts are. Sometimes we forget that. So we need not, I know the national government, especially the executive branch, treats all revenues collected at the national level as if it was their own, and therefore they advance counties a favor by allowing for other counties for some more money to be spent there. That's not the real interpretation. A political interpretation, fine, but it is completely different what constitutional protections require. And we at the Institute of Economic Affairs prefer to emphasize what the Constitution says. Up until the moment the division of revenue is achieved, those revenues do not belong to anyone or the other level of government at all. Now, pegging on-source revenue, pegging allocations to on-source revenues, that would have to be the discretion of the National Assembly and the county governments. But we think it would be a bad thing, because we also don't peg any allocations given to early allocations distributed to the county, to the national government, on any collections of revenue as well. So I'd have a problem with that, in addition to the fact that county governments, where most of the businesses take place anyway, have a view, might have a view at the county assembly to adjust their taxes as they wish. So to ask them to go for maximum tax collection so that they can claim money back there is to actually ask them to make their citizens bear a second tax burden after paying income taxes and all the VATs and consumption taxes to the national government. So if we look at the economy as one, and it really is one, the idea that we should peg specific conditions to on-source revenues is a bad idea. We know that conditional revenues exist, conditional grants exist, which the national government, again, with the agreement of the National Assembly and less so, but with the requirement as well for approval by the Senate, could decide to give conditional grants. And if the national government, for any reason, determines that the conditional grants are necessary to activate more revenue collection at on-source revenues, then it can use that as a conditional grant. But I'd be reluctant for us to continue the narrative that for some reason, revenues collected by the KRA belong by right to the national government, and it should then be determined how much of that counties can claim on account of what on-source revenues they collect. Thank you.
Okay, so thanks, Kwame and Maureen. So help me to appreciate them. You can either clap or show them the thumbs up. So thanks a lot for those insights, and of course to our participants for taking time to join us in this webinar. Of course, as I had mentioned, we'll post these slides in our website. So feel free to download it and just interact with it some more. I want to believe that this has been useful in terms of providing insights that would enable you or would elevate debate and dialogue on this matter of the budget, whether it's taxation or expenditure or budget deficit financing, in all the spaces that you engage in, whether private, but particularly so on, public spaces. So feel free
John,
yes.
My apologies. There's a question. There's a hand up by Richard. So maybe you can give him a moment to ask a question if you really wanted to ask a question.
Oh, okay. So Richard, do you have any question? Yes, Richard.
Not really. Not really. I just wanted to appreciate the speakers.
Okay.
Yeah.
Okay. Thanks for that. Yeah. Yeah. So what I was saying is basically that we hope that these insights will be useful to help you in whatever engagements that you have, whether in private or public. And just to note that the Institute of Economic Affairs is a membership organization. And so if you'd like to be a member, feel free to get in touch with our communications team, or Oscar or Michelle, and they can basically take you through the benefits that you'd accrue from being a member and the requirements for that. Otherwise, thanks a lot, and please look out for any of our events, upcoming events, or publications, research outputs, etc., through our social media handles, as well as through the IEA's website.